I think it's important to understand what is a stock and how the stock market works, because many people are confused about this and they put their money in stocks while they don't even understand what they are buying. And this is very dangerous. The stock market is not a casino, and stocks are not lottery tickets. However, if you don't know what is a stock and how the stock market works, then you are only gambling, not investing. This is very similar to poker, because many people don't know that poker is not gambling. Winners are not determined by luck. Poker is a skill game. Of course, if you play with the computer will surely win always. But if you play poker with other people, you can earn money with it. And you don't have to be a genius. You only need to be better than the average poker player. Because it's a skill game and it has less to do with luck. So this is the same with the stock market. It shouldn't be a casino, but many people are just gambling with the stocks because they don't understand basic things. First of all, what is a stock? When companies go public, it means that investors can buy shares of the company at the stock market. And when you buy shares of a company, you become one of the owners of the company. It's important to know that when you buy a stock at the stock market, you are not buying it from the company. You buy it from another investor. This is why the stock market is also called the secondary market. So when we buy stocks, we buy ownerships in companies. A stock is not a lottery ticket. We are investing in a business that generates money, and not just generates money, but ideally grows over time. Because one of the most important things in investing is that your return will be determined by the growth of the company, whether you invest in growth stocks or dividend stocks. This is why I say all the time that don't just look at the dividend yield. The dividend yield doesn't matter if the company is not growing. Sure, if you buy a bond with a 2% yield, you will get a 2% interest until the end of the bond. But a dividend stock is not a bond. That's why the dividend yield alone doesn't give you much information. It's just one criteria from many. So we are not trying to predict the movement of the prices, at least not in short term. That's why looking at only the price and the price chart is absolutely useless. Many times people ask me the question, this stock dropped 20% from its top, should I buy it now? You cannot predict anything from the movement of the price. This is so important that I need to repeat it again. You cannot predict anything from looking at the price chart of the stock. Of course, people are trying to do that constantly, but nobody ever became rich by predicting short-term movement of the prices, which means that it's impossible to do. Here is an example. You say that the stock price dropped 20%. What if the company makes 20% less money this year? If the company makes less money, then it doesn't matter if the stock price dropped 20%. But what determines the share price in the stock market? If more people want to buy a stock, the price of the stock will go up. And if there are more sellers than buyers, then the price of the stock will go down. This also happens in other areas in life, not only in the stock market. When more people want to buy a certain product, for example, when the pandemic came, more people wanted to buy a face mask, so the prices of the masks went up. This is also called supply and demand. And since buyers and sellers determine the price of the stock, this is very similar to a voting system. And you have to think about why people want to buy a stock and why they want to sell a stock. Generally, investors want to own a stock if they believe that the company is doing great and probably grow and generate more money in the future. And they want to sell a stock if they think that something is wrong with the business. Today, investors can reach every financial data about a company they want to analyze. So they see how much money the company made in the past 5 or 10 years and whether if it's growing or stagnating, or maybe the revenue is going down every year. Based on this data, tens of thousands of investors make a decision and they decide about selling or buying a stock. Of course, people do not always agree which companies are the best investments, but after many sales and buys and many votes, there is always a result. The result is a price that tells us how the market, the investors, price that stock. Most of the time, this price reflects the real value of the stock, the real valuation of the company, most of the time, but not always. First of all, many people buy stocks without any knowledge about the company. They just see that the price went up in the past and they want to buy it, because they think that the price will continue to go up based on the previous performance, which is a dumb thing to do. So this is why stocks are extremely overpriced sometimes. They buy and sell stocks at a price that is much more expensive than the real value of the company. And sometimes there are boring companies that are forgotten by the majority of the people, and even though they are great companies, money-generating companies, people are not buying the stock, and therefore the stock is undervalued. And there are occasions when there is a panic on the market, and investors are completely irrational. This is when a lot of people sell their stocks because they are afraid of losing money. This is exactly what happened last year in March 2020. The S&P 500 dropped 31% in a few days, and many money stocks of great companies were undervalued. This is when I bought stocks at a really cheap price. Some of the companies I bought at that time has doubled in price only after 1 year. So it's important to only buy companies whose finances we know. Because if we know that everything is going well with the company, then it doesn't matter if sometimes the market overreacts and misprices the stock. In fact, when the price of great companies goes down, I'm happy because I can buy the companies at a cheaper price. And this increases my returns on that investment. Today, the market average is extremely overvalued. Almost everything is expensive. This is because people are greedy now, and everyone wants to be part of the momentum. So new people are constantly joining the market and buying stocks. But the problem is many of the stocks are already too expensive, so they buy these stocks at high valuations, which is very dangerous. Investing is not just about buying great companies. It's about buying great companies at the right valuation, at the right price.